Greece joined the Eurozone in 2001. Adopting the euro meant Greek borrowing costs converged toward Germany's, suddenly making it far cheaper for the Greek government to borrow than it had ever been with its old currency. Years of heavy public spending followed, fueled by debt that looked, on paper, just as safe as German debt because it carried the same currency. The 2008 global financial crisis, triggered by the collapse of the U.S. subprime mortgage market and Lehman Brothers, swept through European banks and economies that were themselves carrying heavy debt loads. Greece's economy, already running large deficits, was hit hard, and the government bailouts that followed in country after country only added to the debt pile. In October 2009, newly elected Prime Minister George Papandreou's government revealed that Greece's actual budget deficit would exceed 12% of GDP, nearly double earlier official estimates. After Eurostat applied its own accounting methodology, the final 2009 figure was later set at 15.4% of GDP. The numbers Greece had been reporting to its Eurozone partners had been substantially understated for years. Investors reacted immediately. In late April 2010, credit rating agencies cut Greek government bonds to junk status, with Standard & Poor's lowering its rating to BB+. Once a sovereign loses investment grade status, many large institutional funds are forced or strongly inclined to sell, and borrowing costs spike. Private capital markets effectively froze Greece out, and without outside help, the country faced an outright default. On May 2nd, 2010, the so-called Troika, the European Commission, the European Central Bank, and the International Monetary Fund, agreed to a €110 billion, three-year loan package to keep Greece solvent, conditioned on deep austerity measures, tax increases, and structural reforms. Days later, on May 10th, the ECB launched its securities markets program to buy distressed government bonds, and Eurozone finance ministers backstopped the wider currency area with a €750 billion emergency facility. The crisis did not stay contained to Greece. Ireland's banking system had its own property bubble collapse, and on November 28, 2010, the EU and IMF agreed an €85 billion support package for Ireland, of which about $67.5 billion came from outside lenders and the remainder from Ireland's own reserves. The pattern was now visible. A banking or fiscal hole in one small Eurozone economy could force an emergency, currency-wide response. Portugal followed. After requesting assistance on April 7, 2011, Portugal's bailout program was formally adopted on May 17, 2011, a €78 billion package split roughly evenly between the European Financial Stabilization Mechanism, the European Financial Stability Facility, and the IMF. 3 Eurozone countries were now under emergency external supervision in barely a year. By the second half of 2011, fear had spread to economies far too large to bail out the same way. Italian 10-year bond yields, which investors demand higher when they doubt a government's ability to repay, crossed 7% in November 2011, a level widely seen as unsustainable for a borrower the size of Italy, the Eurozone's third-largest economy. Spain's 10-year yields climbed past 6% in the same period, and would later also touch the 7% danger zone in 2012. The political strain reached Athens directly. On October 31, 2011, Prime Minister Papandreou proposed putting the second bailout to a national referendum, a move that rattled markets further. He withdrew the referendum days later and resigned, replaced by economist Lucas Papademos at the head of a unity government tasked with pushing the rescue program through. On October 26 and 27, 2011, Eurozone leaders meeting in Brussels agreed in principle that private bondholders would accept roughly a 50% write-off on Greek debt they held. When the deal was actually executed through a bond swap completed on March 9, 2012, private investors took a 53.5% reduction in the face value of their Greek bonds, a restructuring affecting roughly €200 billion in debt that is widely described as the largest sovereign debt restructuring in history. On February 21, 2012, Eurozone finance ministers approved a second Greek bailout worth €130 billion, with the combined two-program total reaching about €240 billion transferred in tranches through December 2014. The explicit goal was to bring Greece's debt down from about 160% of GDP toward roughly 120% by 2020, paired with continued austerity. Behind the bond market numbers was a sustained collapse in everyday life. Greek unemployment, which had been below 10% before the crisis, rose to roughly 20% by late 2011 and continued climbing toward a peak near 28% by 2013, with youth unemployment reaching far higher. Greek wages fell by close to 20% between mid-2010 and 2014. This was not an abstract market event. It was years of austerity-driven hardship for millions of people. The turning point for the wider crisis came not from a bailout, but from a speech. On July 26, 2012, European Central Bank President Mario Draghi told a London conference, quote, "Within our mandate, the ECB is ready to do whatever it takes to preserve the euro, and believe me, it will be enough," end quote. That commitment later formalized as the ECB's outright monetary transactions program announced September 6, 2012. Calmed bond markets even though the program itself was never actually used, because the promise of unlimited central bank backing was, for markets, enough. By the time the acute crisis passed, the Eurozone had built entirely new institutions, the European Financial Stability Facility and its permanent successor, the European Stability Mechanism, specifically to backstop member governments, something the currency union had not been designed to do when it launched. The lesson for anyone watching their own finances is general, not a specific recommendation. A sovereign or institution that looks safe because of the company it keeps, like Greek debt trading as if it were German debt, can carry real, underpriced risk that only shows up once confidence breaks.